Hi, I'm Chris Brumlow. I'm a partner in the BAB Group. I'm an investment advisor representative. Welcome to our semi-annual State of the Markets presentation for the first half of 2026. Today, I want to frame where markets stand as we move through the first half of 2026. This is not a forecast designed to drive tactical decisions, but a backdrop discussion on what's working, what's changed, and where risk may be building beneath the surface in the first half of the year. Guiding today's discussion. How favorable is the investment environment in the first half of 2026? Not just in terms of recent returns, but in terms of sustainability, balance, and risk as the year progresses. Before looking forward, let's ground the analysis in the context of what investors experienced recently. Context matters, especially after an unusually strong period for many asset classes. Let's look back at the market activity coming into this year. This chart shows the total return for U.S. stocks, global stocks, international stocks, and U.S. bonds. These are the major asset classes for most investors. The orange bars represent the total returns for 2025, and the blue bars beside them show the long-term averages for those asset classes. What you see in the orange bars is much taller than the blue bars. In 2025, investors were rewarded across most major asset classes. Equity returns were strong. Even bonds delivered better outcomes than many expected. Bottom line, 2025 was a year of exceptional returns. This chart shows the total returns for the past 3 years, 23, 24, and 25. The numbers are annualized and again compared to the long-term 3-year averages. Looking at rolling 3-year returns, recent performances sit meaningfully above long-term historical averages. Again, we come away with the view that the past 3 years of returns in the major asset classes have been exceptional. This doesn't imply an immediate reversal, but it does suggest that expectations should be tempered going forward. If we look at the 5-year annualized returns, the same outcomes is reinforced for stocks. This has been a period of unusually high total returns in stocks. The story is different from bonds, having suffered from the spike of inflation over the past 5 years. Nevertheless, we can say the past 5 years has been highly unusual. Historically, periods of above average returns are often followed by more modest outcomes, not necessarily losses, but lowered forward-looking returns. Okay, with that historical context in mind, we turn back to today's question. In the first half of 2026, how favorable is the investment environment? The goal isn't to predict market direction precisely, but to assess whether current conditions are broadly supported or increasingly fragile. At a high level, the macro backdrop remains constructive. Growth has proven resilient. Consumers are still spending. The labor market is cooling gradually, but still relatively strong. And inflation pressures appear to be contained for now. And while not all the way back down to pre-pandemic levels, certainly much slower inflation rates than 22-23 timeframe. Fiscal stimulus should materialize as retroactive tax refunds associated with the One Big Beautiful Bill come into play. Also, considering that 2026 is an election year, we should assume that the current administration will do everything in its power to create as much constructive economic environment as possible, as has been the case historically during election years. We characterize this environment as generally bullish, with more tailwinds than headwinds on balance. 2026, several things. The first is the Fed's Balancing Act. The Federal Reserve faces more complex environment in 2026. Leadership transitions with Jerome Powell's departure as chairman, political pressures intent on influencing Fed decision-making, and a still incomplete inflation victory make policy less predictable. Remember, the Fed has the dual mandate to maintain price stability and full employment. The labor market has been weakening, which biases the Fed towards lower interest rates. Yet inflation levels are still above target, which biases the Fed towards keeping interest rates higher. This dual mandate will likely create tension, leading to higher unpredictability and volatility in the markets. The next thing that we're watching is what we call the bipolar economy. U.S. economic growth is increasingly uneven. For one, we see massive investment tied to AI infrastructure and hyperscaler capital spending. Additionally, consumer strength is concentrated among higher income households, while lower and middle income household earners and consumers lag. Economic growth appears to be increasingly dependent upon AI investment and spending from affluent households. This concentration presents risk in 2026 if activity slows in one or both of these areas. The next thing that we're asking is, are we in an AI market bubble? AI is a powerful secular trend, but markets often overshoot fundamentals. We looked at historical bubbles in 1929, 1987, 2000, and 2008 to identify the characteristics associated with market bubbles. Those include elevated valuations, increased leverage, herd behavior, speculative market activity, lagging or lenient regulations, the proliferation of esoteric asset types, and sector-specific bubbles. All of these conditions exist in the AI market in 2026 and raise legitimate bubble concerns in parts of the market. The question is not whether AI matters, it does, but whether prices fully reflect realistic outcomes. This environment reminds us of the late 1990s dot-com era. And we recall the then chair of the Federal Reserve, Alan Greenspan, who coined the term irrational exuberance. However, when we look at Greenspan's characterization at the time he said it, we must take note of the fact that the dot-com bubble continued for a full 3+ years before it burst. The Greenspan quote is a reminder that bubbles can persist far longer than rational investors think possible. So even if we are in an AI market bubble, the bubble may continue to expand indefinitely. Finally, we're watching one of the most unpredictable topics that influences the investment markets, geopolitics. Geopolitics risk remain elevated. Ongoing military conflicts, shifting trade policies, regulatory changes, and election uncertainty all contribute to headline-driven volatility. These factors are difficult to predict and nearly impossible to time. Revisiting the question, how favorable is the investment environment? In the short term, conditions look supportive. We generally see bullish environment, but a deeper look reveals concentration risk, valuation concerns, and policy uncertainty that argue against complacency. Investors should not get too exuberant in this environment and should certainly not change their investment portfolios based on the headlines. To put it succinctly, and to use a reference to the 2026 headlines, investors should generally not be adjusting their portfolios based on Greenland. Headlines are not good inputs for long-term investor decisions. The most important takeaway is this: the investment environment matters less than the investment plan. Markets will always fluctuate between optimism and risk. A disciplined, diversified plan is what allows investors to stay focused through both. If you have the right financial plan for your specific situations, the headlines shrink in importance. That concludes our presentation on the state of the markets first half of 2026. As always, take a moment and read the disclosures. This presentation is intended solely for educational purposes and is not an offer or solicitation for the sale or purchase of any security or any other financial instrument, or to adopt a particular investment strategy. All charts and graphs included were for illustrative purposes only. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Opinions expressed are general in nature, subject to change without notice, and not intended and should not be interpreted as specific investment advice for you or your investments or portfolio. Since individual circumstances vary, you should consult your legal, tax, or financial advisor for specific information. This information presented does not constitute financial, legal, or tax advice and should not be used for informational purposes. Any reference to Social Security income or claiming strategies does not necessarily represent the views of Social Security, the administration, or AlphaStar Capital Management. Again, thank you. My name is Chris Brumlow. I'm a partner in the BAB Group, an investment advisor representative for AlphaStar Capital Management. We have offices in the Atlanta area and in the Tampa area. If you'd like more information, please feel free to reach out.